If you've watched any of our content at all, you'll know that a big goal of ours is to make sure that you are the most prepared buyers and sellers in the Fairbanks real estate market, and this video is no different. In order to be the most prepared buyer in our market, you need to show up ready to play, and you need to have a pre-approval letter from a financial institution or a mortgage broker that you trust. Make sure you watch to the end of the video because there are a few pro tips that I sprinkled in there that you're not going to want to miss. So a lot of times realtors and agents and licensees, they use all these different words, will throw around the phrase pre-approval, we'll say pre-qualification letter. And for the most part, a lot of people think that these are interchangeable words, but the pre-approval and the pre-qualification letter are a couple different things. Now the pre-qualification letter is something that when we are looking at these, and when any lender is writing one of these, what they're doing is they're giving you essentially a 90% letter. So they're about 90% sure that you are good to go in terms of being able to lend to you. So a lot of times they're not pulling a whole lot of information in terms of they may ask for a couple of pay stubs. They may, take your ID. They're not going to go as deep as they typically do for a pre-approval when they're running your documents for a pre-approval. They'll take your credit score, but what they're going to end up doing is kind of giving your financial picture a cursory look, and they're not going to do too much work on the front end. Now, what they're relying upon is the contract and the first 15 days or so of our contract to use that time to shore up that other 10% to make sure that you are really good to go for the amount of money that they've pre-qualified you for. And during that time, they're going to put you through an underwriting process and make sure that, like I said, you're good to go. Now, the pre-approval process is a little bit different. What most lenders or brokers, mortgage brokers are doing during that time is running all of your information. So they're going to ask for everything. They want pay stubs. They're going to run your credit. They're going to look at your debt to income ratio. They're going to look at all of this huge list of 10 things I'm about to talk about. And they're going to make sure that you are 100% good to go. They're going to pre-approve. They're going to underwrite you up front, either through a manual process or through an automated process to make sure that you're good to go. And you get a little bit something extra when you go through the pre-approval process, because rather than using that first 15 days of the contract that the lender that offers you a pre-qualification letter does to shore up that 10%, your lender is not worrying about that stuff, because with a pre-approval, you're good to go. You have already been underwritten. All of your documents are already safe. So a lot of times what a really good lender that offers this pre-approval process will do is they'll offer you a guarantee on your earnest money, because they are so sure that they have taken care of the underwriting process, that upfront pre-approval process, that they're willing to offer a guarantee on your earnest money. And that in itself makes the offer that you write pretty fantastic, because not only are you being able to show your prospective seller that you are 100% underwritten, your lender has gone through the process of making sure that your financials are on point, but they're also willing to guarantee your earnest money. Now, one such lender that is right here in Fairbanks that you can absolutely work with is Bethany Yoakum at First Rate Financial. Not only will she go through this automated or, if need be, manual underwriting process, in order to get into a real estate transaction, having that earnest money guaranteed up to $5,000 is huge. Having a pre-approval letter with a lender that you can trust is huge. And then having the time to be able to go out and view these homes once you're armed with earnest money and a pre-approval letter from a lender you can trust, amazing. So being able to start out this whole process with talking with a lender that you can absolutely trust to have your back and to be able to take care of you through this whole process is awesome. So forgive me for taking a little while to ramp up into this one, but I wanted to make sure that we had a really good understanding between the pre-qualification letter that a lot of people will just rip off and send to you. Yeah, $400,000, here you go. And a lender that will take the time up front to do a lot of the hard work up front, like Bethany Yoakum at First Rate Financial will do, and make sure that you are squared away. So without further ado, let's get into these 10 things that you're going to need to get to start that pre-approval process. All right, number one is personal identification. This one should really go without saying, but just in case we're going to say it anyway. you're going to need an ID. You're going to need to have some way to be able to identify yourself and demonstrate that you are who you say you are. And this is important to have kind of upfront, because throughout this whole process, you're going to have to be able to show several times that you are who you say you are. When we go to the title company in order to close and sign and say, hey, congratulations, this house is yours, you're going to have to show them a copy of your ID, whether it's a driver's license or a CAT card. It doesn't matter. You're going to have to show you are who you say you are. As I was saying, this can be a state-issued government ID. It can be a passport. It can be a driver's license. It can be all kinds of things. So if you have questions about it, you can absolutely give us a call, 907-885-0316. All right, next on our list is a Social Security card. This is something that you're going to need as well, provided that you have one. It does add another layer of difficulty if you don't have a Social Security card, but it's definitely going to help you confirm who you are in terms of being able to look back at all of your prior tax documents, if you filed them. Hopefully you have. But it's going to be able to set you up to show you are who you say you are in terms of all of the tax documents that you will have filed throughout your life. All right, number 3, pay stubs. So being able to have pay stubs from your employers, all of them, anybody that you're being paid by, you need to be able to show proof of income from. So pay stubs, W-2s, we'll get into W-2s later. Pay stubs, being able to show, what your income looks like from your employer, showing what taxes have been withheld as well. If you have a physical check, having a few physical checks will also work, but you want to be able to show a history of consistent paychecks. That's what your lender is going to be looking for, to make sure that you can demonstrate that you've got a consistent form of income. And also, while we're on this subject, you want to have all of your forms of income. So all of your pay stubs from, and I kind of said this before, but from all income sources. Every little bit is going to help, and if we need to explain where this money has come from, that's fine. We can just work on explaining where the money came from. Let's make sure that we have a good, thorough explanation for where all of it came from. Here's a little pro tip. So while you're working on gathering up all of your pay stubs and getting all this information from your employer, if you happen to be doing that, this is a great time to be talking with your employer, your supervisor, somebody with HR, anybody at this stage, to let them know that you're going to be buying a house and that somebody from your lending institution is going to be reaching back to have a conversation with them in order to verify employment. This is a step that gets overlooked a lot, and we will be waiting towards the end of a transaction for somebody from your lender or somebody from your form of employment, somebody from your job, your career, to reach back to our lender or to your lender to be able to say, yep, so-and-so does in fact work here, and unless something unforeseen happens, should be working here throughout the next calendar year or so. We'll be waiting on that. And it can be a kind of a pain towards the end. So identifying this person up front and figuring out a form of communication to get between your lender and whoever this person needs to be is a game changer. So keep that in mind at this point in your pre-approval process. Bank statements. So bank statements are required for the pre-approval process because what your lender is going to be looking for is, one, to verify your income again, but they're also going to look at how you can afford, if you have a down payment. They're going to want to see if you've got the balance in your accounts to see that you can afford that down payment. But they also want to look for any kind of red flags within your bank statements. They want to see if you've got any bounced checks, any insufficient funds notices, any unstable income, so income coming in from anywhere that they would need to identify and get an explanation for. They want to see notices of payments to any other bank accounts or large deposits with weird sources. They want to look and see if there's any kind of malfeasance or any kind of issue that might come up during a transaction that they need to identify at the first step. That way they can start to take care of it now so they don't have to worry about it later. Next on our list is tax documents. So certain tax documents are absolutely going to be needed, and what you're going to definitely need are your most recent W-2 forms. If you are an employee of somewhere, if you work for somebody else as an employee, you're going to need your W-2s. And you're going to need those for probably the past couple of years. If you've got 2 or 3 years, that's fantastic. So being able to show your past W-2s is awesome. And again, with this, what they're doing is they're looking to verify your income. They want to see that you've made money, see that you're not losing money hand over fist every year to taxes as well. If you're not an employed person, if you're self-employed, like myself, I'm an independent contractor, so I get paid with a 1099. So being able to show my 1099s and all of my historic taxes to be able to demonstrate that I've got a stable form of income over the past couple of years is how it would work for somebody that's self-employed or an independent contractor. And so for those of you that are self-employed, you'll need to have a couple of years of income at the self-employed level in order to be able to demonstrate that you have some, income at a pretty stable level. Another little pro tip for you. Thinking about moving to Fairbanks? Well, click on the link below for my free relocation guide where I talk about top schools, top neighborhoods, and so much more. Number 6 is any investment account statements. So if you've got any statements from a 401k, 403b, IRAs, stocks, bonds, mutual funds, any of those, we're not trying to keep anything secret from our lender. Being able to show that we've got, some money squirreled away in some investment accounts does not hurt you really, especially if you are buying some income producing property and you need to be able to show that you've got some reserves, some money held in reserve to be able to cover a multifamily property. This is a hypothetical, but if you're buying a multifamily property and you need to be able to cover 6 months worth of reserve mortgage payment, having money in an investment account or several investment accounts are a great source for being able to take care of those reserves. If you've got any investment account statements, these are also needed during the pre-approval process. All right, number 7, a list of monthly debts. So this one is where a lot of people get hung up. And this is kind of the reason why I didn't talk about it too much when I was talking about bank statements. They can have plenty of income, tons of income, but their amount of debt in relation to their income can still be too high. The magic number, so to speak, for most lenders is around 43%. So if you've got $10,000 worth of income, they want you to have no more than $4,300 worth of debt. So that's a dollar for dollar little example there. Now, the debts that they're going to be looking at in terms of determining what your debt to income ratio looks like are both rent and mortgage. So they're going to take into account what your new mortgage would be. If you have any current mortgages, they're going to take that into account as well. That can be a tricky thing for current homeowners that are looking to buy a second home in another area. This can be one area that can lead to a contingency being in place for your new pre-approval letter. So they'll issue your pre-approval letter contingent upon the purchase of your current home or somebody buying your current home. They'll also look at your car loans. They'll look at student debts, credit cards, personal loans, homeowners insurance, and HOA fees. If you're looking at purchasing a condo or a home in an HOA, we don't have too many homes in HOAs up here, but condo associations we absolutely have. And they're great because they cover, a lot of times these condo associations are covering like heat and water or electricity, lots of different things for some pretty reasonable money. But when they add in those, or when the lender is looking at your debt to income ratio and they add in those HOA fees or those condo association dues, that's where it will take somebody from being within the regular debt to income ratio to being outside of the debt to income ratio. And then we've got some problems. Despite the fact that some of those condo association dues are going towards utilities like heat and electricity or heat and water. So it can make it kind of a sticky situation when we're like, well, look, this is kind of going to save us some money moving in here. And our debt to income ratio is really going to be smaller, but no. This is something to be mindful of when we're looking at our pre-approval and when we're looking at homes as well. Just because we're pre-approved for X number, if we start looking at properties with condo association dues or HOA dues, that may change kind of where we're looking in terms of our overall pre-approval number. So another pro tip, keep that in mind. So one other thing to keep in mind when we're looking at the debt to income ratio is that when you're giving a report or you're giving an explanation of these debts, make sure you're including who you're making the payments to, contact information, the total balance, and the required monthly payment too. Because a lot of these things, if we're talking about a really, really awesome lender, especially like Bethany Yoakum, we can work out some pretty fancy things when it comes to the offers that we're writing and seeing if we can use some closing cost coverage to cover some of these recurring debts to see if we can't reduce some of that debt to income ratio too. So keep those in mind. There are some things that we can work on that may help your debt to income ratio. So make some special notes. Monthly, like variable expenses, aren't included in your debt to income ratio. So things like your utilities or groceries, your entertainment, transportation, your cell phone bill, That stuff is not going to be included in your debt to income ratio. Next on our list is rental information and landlord references. So this is kind of a newer thing, and it's about time too, because like I was saying before, we've had loads of people that have been saying, well, I can afford paying my landlord $2,500 a month, but for some reason, a lender will look at that and say, nope, can't do it. We can't approve this person. Now we can, now lenders can. I'm not a lender. But what they need in order to be able to use that information is a pretty beefy form of references. So this is kind of a newer thing, and it's about time too, because it didn't really used to be this way. As landlords, they don't report their rental payments, whether they're made or they're not, to any of the credit bureaus. So there's really no way to help or hinder tenants that are making or are not making their payments on time when it comes to maintaining a credit score for on time or late payments to a landlord. So it's kind of a screwy system, because tenants can be making stable payments on their rental that they're living in for years and never get any kind of credit for it in terms of having a beefy credit score for making that solid payment every month. And that's kind of awful. So now what they're able to do is get a list of names, contact information of the landlords that you've been kind of renting from previously. And now they're able to kind of call and check and do a little bit more of some digging, essentially, to be making sure that you're kind of getting some credit for the good things that you've been doing the entire time that you've been renting, which is awesome. So keep this in mind. If you've been renting for a long time and you're thinking now is the time to buy, start doing some homework on the places that you've been renting. Get their contact information, get the years that you've been renting from them, and call them and say, hey, look, I'm looking at buying a house. Is it okay if I have my lender reach out to you? Because I want to make sure that that they're taking everything into account to help my credit when I go to look to buy a house. So gift letters. This can be a big one, and it's one that we see from time to time, and it's something that's super important. So we had talked about looking at bank statements or lenders looking at bank statements, and it's super important, because sometimes people will get a gift from a relative to help with a down payment to help buy their house. I don't know about you, but I don't have a lump sum of cash just sitting around to go afford the down payment on a piece of property. Part of the reason why I've used a VA loan to buy every time that I've bought. But there are those with families that have given gifts of money to help afford a down payment on a home, which is awesome. They show up and they're ready on day one to buy with a down payment. That's fantastic. But when a lender goes back and looks at their bank statements and sees this sudden influx of $20,000, hypothetically, it's kind of weird. And they're like, well, where did this come from? Where did this personal check for $20,000 come from? What did you do to get this? So having a gift letter to show, look, my mom and dad gave me $20,000 to help me buy a house. This is the reason why they gave it to me. This is when they gave it to me. It helps to show your lender, hey, look, I wasn't actually selling drugs, and I ended up making this $20,000 because of it. For some reason, somebody paid me in check with the same last name, but here it is. And it helps kind of cool everybody down and chill everybody out a little bit. So if you're going to get a gift, because a lot of loans these days will allow you to have a gift set of funds, and you can get these gifts from anywhere, not just relatives. FHA loans will allow gifts from your employer. They'll allow it from labor unions, first-time home buyer programs, and family members. So the sky's the limit in terms of where these gifts can come from. You need to have, for a good gift letter, the person that gave it to you, their name, their contact information, their relationship to you, good contact information. I said that already. The gift amount and the date that the gift was received. You need to be able to show a really good paper trail, essentially, for when and where this money was received. And you also need to be able to show confirmation from them that the gift doesn't need to be repaid. And having a signature from them, if you can get it notarized too, chef's kiss. That's it. It's pretty easy. Once you've got those things taken care of, your gift letter is perfect. Last one is a credit report. And this isn't something that you need to have kind of ready for your lender to do, because they're gonna pull your credit anyway. Now, the credit report's gonna be able to show your lender what kind of borrower you are and how well you treat different types of debt. It's gonna reveal any kind of big red flags you have, like missed payments or huge debts or bankruptcies. But the other thing that it's gonna do is it's gonna kind of fill in all of the missing pieces along with the other things that we've talked about already. So it's kind of like if there was a big pool party, like everybody's in the pool and they're having a good time, like all of your documents are in the pool having a good time. The credit report is the water in the pool. So everyone's swimming and having a great time, and the pool is what makes the party. So I just came up with that myself right now. So when all of these things are kind of taken into account, including the credit report, that's when they're making the final kind of decision about what kind of borrower you're going to be. Because not all of these things are kind of make it or break it on their own. Now, you could definitely have a credit score that was, top shelf. You could have an 800 credit score, but have a debt to income ratio that was so high that no one's going to feel comfortable lending you money. But because you've got all of the other things that look really, really well and look really, really great, you could probably find a lender that's going to say, wow, despite having this super high debt to income ratio, this is a fantastic borrower. We're going to do this. We're going to, they've got their ducks in a row. This is something that every borrower is going to need to go through is their credit report, and the lender's going to pull it on their own. So you don't need to do this up front. It's something that they're all going to do. Now, I'll put some links down in the description if you want some free places to be able to check your credit score. But keep in mind that your credit score alone won't, like I said before, it won't like make it or break it for you. It's not going to give you the ability to qualify for mortgage pre-approval just because of what number it is. All of those other documents and all of those other things need to be taken into account to determine whether or not a lender or broker, it's going to take into account all of those other things to determine whether or not they're going to approve you for a home loan. Another pro tip, I don't know why I said number 2, be mindful of how many lenders you contact about getting pre-approved for a home loan. You're going to get all your documents together, and having them together means that you can talk to several people. So because if you give them to one person, it's just as easy to give them to several others. But try to keep it under 3 people or three lenders, because if it looks according to, and this is kind of just like an old realtor's tale, not an old wives' tale, an old realtor's tale, but it probably has some credence if you talk with the lender about it too. The more lenders that you look at sending your information to, and the more hard credit pulls that they end up doing, the more it looks like that you're trying to borrow money from everyone. And whether you're getting approved or not, the more hard hits on your credit, the worse it's going to look to your credit score or to somebody that's pulling your credit, because every one of those hits registers as a flag, as like, hey, so-and-so's looking at their credit score. So you don't want to be doing that more than 2 or 3 times. So if you're looking for somebody that you can absolutely trust, as I said before, take a look at Bethany Yoakum. Here's the last pro tip. And I'm telling you this because I want you to save as much money as possible. And I don't know of anybody else that's really going to tell you this and be this blunt about it. Don't be lured into a false sense of security that just because you have several accounts with any kind of financial institution, that they're going to give you some sort of special deal for your home loan. Banks don't necessarily work that way. So just because you have a savings account and a checking account and you've always banked with XYZ financial institution doesn't mean that they're going to take care of you the way that every other lenders would. It's a huge misconception that they are counting on, okay? And I know that sounds terrible, but many times, this is honest to goodness truth, many times the loyalty that you have is misguided fear that you're going to miss out on a deal that they're going to give you because of your loyalty. They're not going to give you a deal, and or that somehow you're going to get punished for having a home loan somewhere else. They're not going to punish you for having a home loan with somebody else. So I promise you, neither of those 2 things are going to happen. So because they can't do that. No one's going to punish you. How are they going to punish you? 1. 2, what deal are they going to give you? The only deals that they can give you are the same deals that any other lender is going to give you. The difference is being able to shop. Like I said, check out 3 and ask them point blank, what are the benefits of getting my home or getting a pre-approval letter or getting a mortgage through your financial institution? How is that going to save me money? Knowing that information up front is pretty huge. So relying upon the loyalty that you have for your financial institution, which is fantastic, I love that, doesn't really get you anything. So believe it or not, there is one that can save you money up front. Bethany Yoakum at First Rate Financial and here's how. So we talked about closing costs before, and one of the things that First Rate Financial does not do is charge a lot of closing costs. Because they are a mortgage broker, they don't charge thousands of dollars in a lot of upfront fees, and they end up saving a lot of our buyers 1 to 2% of the purchase price of their home in just closing costs alone. So they're able to give buyers the same interest rates, the same loan packages, but the difference is they're not having to pay for as much upfront in terms of closing costs. So hypothetically, if you were to buy a $400,000 home, because they're saving you 1 to 2% of upfront closing costs, they're saving buyers between $4,000 and $8,000 in upfront fees. How is any bank on the street competing with that with the same rates? I don't know, but it's worth having a conversation. If you'd like to talk with a lender like Bethany, like I discussed, that can get you the same rates, but at a lower upfront cost, wink, wink, give us a call and I can help get you guys connected. Hope you got some value out of this. If you did, give us a thumbs up. Make sure you subscribe to our channel so that way you can see more Fairbanks related real estate content. We're putting out videos twice a week to help our viewers be the most prepared buyers and sellers in Fairbanks. If you've got questions about these topics or any others, you can drop them in the comment section below, or you can give us a call at 907-885-0316. You can also check out our website at www.fbxhomesearch.com. Have a great day.